My new 3-fund portfolio is the ultimate way to invest to keep things simple and to get amazing returns with an average rate of return each year around 20% appreciation for the past 5 years. While that's great growth, that's nothing compared to some of these other assets that are going crazy lately. This year alone, Bitcoin is up over 125%. Super hot stocks and AI are crushing it, like NVDA, which is up almost 200%, and then Palantir, which is up a staggering 360%. Then there's MicroStrategy that's up a crazy 476% in just 1 year. The crazy thing is that all of these still have upside and still have a possibility to grow. And these are just a couple of the options out there. So how can you stay diligent and stay disciplined to have a nice, solid, safe, sustainable portfolio, but still catch some of this upside? I'm going to explain how Warren Buffett has done it all of his investing career, and he's had a pretty good career if you ask me. I'm also going to give you a couple of options to consider based off of what your risk temperament is and based off of what your overall goals are. So I'm going to give you some actual percentages and some examples of what your portfolio could look like by adding in some of these super fun, crazy assets. I'm Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. So Warren Buffett is arguably one of the best investors to ever do it. He's always invested with this very important tactic, and this is called margin of safety. A margin of safety is a built-in cushion allowing for some losses to be incurred without major negative effects. In investing, the margin of safety incorporates quantitative and qualitative considerations to determine a price target and a safety margin that discounts that target. Now, the actual margin of safety that Buffett uses is more so for individual stocks, but it definitely applies to your portfolio holistically and in a full way. The main issue in jumping into some of those super fun stocks and super fun assets that I talked about earlier in this video is that obviously it's super cool to watch them go crazy and go up 200, 300%, but you just have to understand that an asset that can go up that fast can also drop that fast as well. So if you go in heavy with that, you're adding so much risk to your portfolio, especially the closer you are to actually needing that money. So if you're anywhere near retirement, or if you're just thinking about using that money for anything in particular, like you're saving up for something specific in a couple of years, having it in those volatile assets makes it very risky. Taking your life savings of like $100,000 and cutting that down to $20,000 within a year is definitely going to be devastating. So the margin of safety is something that you need to build for yourself, specifically keeping your portfolio safe, but in a way that actually lets you get more of that upside. To do this correctly, you actually keep yourself so safe that you can actually go harder and you can push further to go into that more aggressive stance to be able to get more of that upside. You just want to make it so that if you do lose somewhat on this bet, that you're not going to lose overall in your entire portfolio. Benjamin Graham concluded that if he could buy a stock at a discount to its intrinsic value, he would limit his losses substantially. Although there was no guarantee that the stock's price would increase, the discount provided the margin of safety he needed to ensure that his losses would be minimal. So again, what we're trying to do is get some exposure to those fun stocks or fun assets to try to get some upside, but we definitely want to keep in mind safety while doing this. So in the 3-fund portfolio, we have 3 basic categories. The first category is one everybody knows, and that's like your market average or the foundational category. That's going to be like your S&P 500 or total US stock market. It's not going to go up like crazy. It's not going to go down like crazy. It's basically just doing what the market average is. Then you have 2 different categories on either side. The more risky category is going to be the one that's higher growth. It can go up much further than the S&P 500, but it's very volatile and can drop further as well. Then on the other side is your safer category, and this is going to be low volatility. It's less volatile than the S&P 500, keeps your portfolio a little bit more stable, usually has cash flow like dividends, and so this one would be like the dividend cash flow / low volatility side. So specifically, how to invest in these things with actual percentages. First, you need to know yourself. What type of risk are you willing to incur? Are you willing to just add some risk to the current portfolio that you have so it will become just a little bit more risky? Or do you want to keep the risk the same overall in the portfolio but still have exposure to these riskier assets? Or do you want to shoot for the moon big time with these risky assets, but at the end of the day still do it in a safe way? I know a lot of that sounded similar. But here's some examples. You're gonna go off of what your 3-fund portfolio is already set at, so you should have percentages that you're comfortable with. I'm gonna go with this structure: 40% in the low volatility / dividend, 30% in foundational, 30% in growth. So the first type of person would be this person that wants to keep their portfolio risk the exact same. They want to add in these new assets, but they don't want to change the riskiness overall of the portfolio. The mistake I see people do here is that they say, okay, well, I know that the stuff that I'm putting in is a part of growth. So if I have 30% allocated towards growth, then I'll just make 20% in a safer ETF like SCHG for that section, but then I'll go 10% into Palantir. If you do that, you don't have the same risk, you just made that section much more riskier. And then you haven't changed anything else for the rest of the portfolio, so all you've done in total is made that portfolio more risky. If you want to hope for the upside but stay safe, you need to actually bring down the percentage of the category in total and then add to the safer section. So it would look something like 45% in the low volatility / dividend, 30% in foundational, and then 25% in growth. Let's say you're that second type of person who's okay with adding in more risk to the portfolio. Still wants to have some balance and have it less risky overall, but in general, they're okay with and understand that adding something to the portfolio will just make their portfolio a bit more risky, but definitely have more upside. Then you can keep the 40-30-30 split, knowing that you may gain a lot more that way, but you have to understand that you're definitely adding some risk in that regard. The third type of person wants to keep the percentage of these fun assets high, but also wants to keep the structure of their portfolio the same and keep their safety very, very strong as well. The best way I've seen one do this is by actually balancing out both sides and customizing both sides. If they're gonna make the risky side even more risky by doing something like 15% SCHG, 10% Palantir, 5% Bitcoin, then they need to go over to the dividend / low volatility side and go 30% SCHD and then maybe 10% in a CD or money market or high yield savings account. So basically, instead of having it be 40% in a low volatility section, it's more like 30% low volatility, 10% no volatility. This gives one the best of both worlds by limiting downside a bunch, but keeps the hope of upside very strong. So obviously, based off of your risk and based off of what type of assets you want to throw in there, you just have to make sure and balance throughout. You can't just add something and then hope for the same thing that you were doing or the same level of risk that you had. You have to know that with possible reward comes possible risk, depending on what it is that you're putting in there. Either way that you choose, just think overall deeply about your goal, not just emotionally hoping for the best. You need to protect yourself and your hard-earned money. Reach out to me if you want to talk about strategies with the email down below, because it can get confusing, and bouncing ideas off somebody who literally does this every single day is always a smart move. Watch either of these 2 videos to keep you going strong in investing, and remember to keep investing simplified.